Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow, Chicagoland Retirement, with your resource, ladies and gentlemen, for a common sense approach to planning, helping to uncomplicate and clarify the financial, the investment, the retirement planning world. And we need a little common sense and clarity there. He is CFP, Certified Financial Planner, Tim Stearns. Tim, always a pleasure to have you on board.
Peter, thanks for having me.
Well, again, yeah, Tim, always a pleasure. And there's a lot of fear right now. I mean, and I think justifiably so. We've enjoyed this market run that we've been on, but a lot of folks, because the market has done so well, are taking a high level of risk in their portfolio. And I'm hearing a lot of concern and worry about when the downturn is going to happen.
Well, what we've noticed, a lot of people are coming into the office and they might mean to have a 60-40 split, 60% in bonds and 40% in stocks. And they actually, the stocks have kind of taken over because they've obviously grown better than the bonds. And they don't realize kind of some of the undue risk that they're taking.
So, Tim, as we are looking at where the market is, I mean, we take risks in life. Sometimes maybe we're thrill seeking and just for fun, we'll take a little bit of risk. We take risk when we change jobs for career growth and family protection and to improve our economic status. We take risk every time we leave the house and hop in a vehicle. But with our investments, we are told we have to take risk in order to make progress. And it seems like the reward that people expect to make and the risks that they take are very intertwined. Maybe we should separate those two things, because risk is not reward. And when we take risk, we have the possibility of losing money.
Well, you have a 12.5-year bull market. All good things will come to an end. And you and I have talked about this, every 7 years on average, the market corrects, and we're at 12.5 years. So I think people are kind of riding the high, even though they forget about 2000 through 2002, they lost about 50% in their portfolio, or 2007 through 2009, where it lost yet another 50%. If you're going into retirement, that can't happen because you're not going to be filling up that bucket anymore. You're not going to be working. The only way you'll have growth is by the market going up, So we talk a lot in our retirement classes about stop losses, making sure that you take a look at how much risk you are actually taking, and what different types of risks are out there.
Now, it's not the only way to have growth. If the market is what we base our progress on, then the only way we will have growth is if the market goes up. But it's not the only alternative that's out there, right, Tim?
Right. I mean, there's the one thing that we were talking about the other day in class is that, a lot of these people have correlated risk, right? So if the stock market goes down, their bonds and their stocks go down. And I ask people, do you have anything uncorrelated? CDs, bank accounts, things that are not going to be affected by the market, a fixed index annuity, these different things that are going to offset some of the risk and take the onus off of the market's performing for you to have a good retirement. So that's kind of what we try to do with people, is expand their horizons, get them diversified.
Well, if in fact the market does have a downturn, Tim, as you already indicated, a lot of folks have more risk than they truly understand or believe is necessary or appropriate because of how far the market has come. Now, quantifying that by just opening the statement and looking at our balance is kind of difficult. That's part of the process there at your office is helping people to quantify the risk and then assess if it's needed or appropriate or acceptable.
Right. Well, I mean, one of the things we do for people is that we'll send them a link to a risk analysis software that we use. It's really easy to use, and we can kind of get some real data on people and see kind of where they're coming from. Then we go another step further and see what kind of numbers they bring back from their portfolio. And a lot of times they're not real happy with what they see because they realize that they've been taking a lot of crazy risk.
I mean, that may have paid off over the last 10 years. They may be happy
Sure.
with the balance, but
Sure.
when you understand the amount of risk that's associated with that balance, if it's a higher balance and we're taking more risk, we are jeopardizing losing more of that money.
Right. Exactly. And, it's, easy come, easy go with these stock markets nowadays. And I'd love to have my grandfather's stock market where, just continue to go back up in the late 1990s and that type of thing. But, we've kind of dealt with the M, it goes up, it goes down, it goes up, it goes down. A lot of people are using these target date funds, using the rule of 100 where, 100 minus your age is what you should have in stocks and bonds. And I don't think they understand that those are not a silver bullet, and if you're over 59 and a half, I would tell you, make sure that you get into something that you're self-directing, so that you can have stop losses, so that at this point of your career, if you're over 59 and a half, you can't withstand those losses.
Well, on today's program, we're going to talk about many of the financial risks that we face, the reality of them coming to fruition. Should we be concerned and have some fear of a market downturn into our future? If so, what should we do about that? And if you've got questions or concerns, you're always welcome to be in touch. Pick up the phone, give Tim Stearns a call, 800-640-2256, 800-640-2256. You can also go online, tjstearns.com, and there's a great contact form. You could submit some questions there as well. We might cover a few of those a little later on in the program. Again, tjstearns.com, or just give a call, 800-640-2256, 800-640-2256. And Tim, as part of the review process that you offer, that risk analysis, bringing that risk into alignment, that is part of the process so that you can help people be appropriately balanced in their portfolio for not only their acceptance and tolerance and willingness to be exposed to risk, but what their goals are into the future may actually take significantly less risk than most people are taking.
Right. So it begs the question, do you know what your risk is? And so we always are trying to ascertain what that is. I've had a couple of people come in here. They're very, it was not a very pleasant experience because they realized that they're taking a lot of undue risk in a market that's at all-time highs. And, we've talked about this. Inflation's pegged around 5.3%. Things are not great out there. And we need to be more cognizant of what's going on in the markets and be strategic, active, and tactical when it comes to your portfolio. We don't usually use the buy and hold for obvious reasons because it doesn't seem to work. But some of the different risks that are out there that I've noticed, everyone talks about market risk, and I'm really good with that. But one of them that I can't get over that no one really knows about it. When I'm teaching classes in Florida, Arizona, or here, sequence of returns risk. Basically, the last couple of years that you're working and your first couple of years in retirement will set the tone for how you're going to do in retirement. Is your money going to last? And no one seems to know that. Another one would be withdrawal rate risk, where people are taking out not enough money, and not really living their retirement, or they're taking out too much money, and the possibility of them running out of money would be terrible. And then the last one, I think probably the most important one, according to Tom Hegna, who we've had on the show, longevity risk. That's, hands down, he says that is the number one risk in retirement. Why? Because we're living longer and longer. The average male is, they say on SSA.gov, Social Security Administration.gov, 85 years old for a male, and a female, it's 88. So these are things that we need to be kind of ahead of and make sure that if you're doing a written income plan, you've made sure that you're being able to pay the bills and growing your money at the same time.
Well, again, so market risk not necessarily the only risk out there, and to identify and address each one of those is an important part in your planning process in order to confidently move forward toward an optimal outcome. And the help and the assistance of a qualified, experienced professional can certainly be very beneficial there. That's why Tim Stearns is educational in his approach here on the program, making sure that you are informed of these, but also offers the benefit and the value of that next step, the ability to sit down and go through a planning review, a strategy session, and get that protect and grow plan in your hands. If you'd like to take advantage of that offer, all you need to do is pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194, or go online, tjstearns.com, tjstearns.com. If we stick strictly to the conversation, first and foremost, Tim, about market risk, is there a rule of thumb to know how much we should be taking or how much we are taking?
Well, I mean, in 1952, they came up with, out of University of Chicago, of all places, this guy Markowitz came up with a theory, that modern portfolio theory, he called it, where you took literally 100 minus your age, and that's kind of where you ascertain where your risk should be. Unfortunately, that doesn't always work, and it's not a fail-proof thing. And the reason I say that is, in the last 20 something years, it's failed 5 times. So the modern portfolio theory from 1952, a lot has changed. The markets are completely different nowadays than when he did that. So that's why you see people are using the target dates, but they don't always provide the comfort and the less risk. One of the things we show in class is the Vanguard 2010 fund, that in 2008, it lost 39.3%. If you do that right before you're going to retire, that could just decimate your entire retirement.
Yeah, I mean, this is a fund that is specifically designed for those that at that time were intending to retire in 2 to 3 years, losing about a third of its value. That changes your outlook for retirement pretty significantly.
Right, I agree.
And there are other target date funds right now, again, 2 to 3 to 5 years out, Tim, that have the possibility of the same kind of results.
Right. So, I mean, again, it's not a silver bullet. That's why I think you need to be, we use separate money managers. And I think that's how we outperform other rank and file mutual funds. Remember, the Investment Company Act of 1940 created the mutual funds that allows us all to pool our money together and buy stocks or bonds or what have you. But one of the rules in there since 1940 has been that they have to stay, a money manager who's running a mutual fund has to say 80 cents on a dollar in the market. Now, don't get me wrong. If you call that company that your mutual fund's at and say, go to cash, they have to do that. But a money manager is not going to call you. One of the things we asked at class the other day, I said, by a show of hands, how many of you have had an outbound phone call from your 401k in the last, year? And it was a resounding no. No one had. And I'm being a little bit facetious when I ask that question because I know the answer, but it's good to let people know about that law, that, it doesn't help you, and unless you get proactive, the money manager can't.
Well, again, these are things that I think we need to know and understand, that maybe we are not as educated on as we should be. And a lot of people love the automatic nature of 401k savings and love the autopilot kind of feeling of those target date funds. But perhaps in reality, in the real world, Tim, they do not do as they are intended or designed in theory. Right.
And I think that people, want it to be the silver bullet, and it's just not.
Well, again, if you want to get a better understanding, if you want to look at being maybe a little bit more strategic and tactical and proactive, if you would like somebody to help you monitor your accounts and your financial progress on an ongoing basis, Tim Stearns offers to be that resource for you. He is a CFP, a certified financial planner. That designation carries with it a lot of responsibility, a lot of training, that fiduciary responsibility to his client's best interest. That's a very, very important distinction in this financial world. If you'd like to understand the difference that can make and the benefits to you, pick up the phone, give Tim Stearns a call, 800-640-2256. That's 800-640-2256. Tim, in addition to this radio program and the great information that you provide Chicagoland area savers and investors week after week, you offer a number of additional educational opportunities, the retirement classes that you teach throughout the area, the book that you offer, the one-on-one strategy session. However people want to learn more and do better financially, you give them the opportunity to do it.
Right. And the nice thing about the college classes, we hold them, like you said, in the area. One the other day was at Roosevelt University in Schaumburg. They're 2-hour classes, and we cover everything from investments to insurance to Medicare, Social Security, things that are concerning the baby boomers. And I think that's where the people really pick up a lot of information, because there's a lot of misconceptions out there. People don't know how, for example, if a spouse dies, the larger of the two Social Security stays, but the other one drops. People don't know that. And I think they think that, they're going to get a dual income forever and ever. And that's just not the case. So we try to educate as best we can. It costs $40, which goes to a charity for kids to go to college. So it's a good cause, and we give our time for free.
Well, if you would like to take advantage of any of those educational classes, the opportunity for the one-on-one review, the plan design, the strategy session, you can do so just by calling. And that Protect and Grow plan, similar planning reviews and plan designs, they can easily go upwards of $1,000 to several thousands of dollars. Tim doesn't want cost to get in the way of anyone having a plan. That's why he makes it available to radio show listeners. No cost, no obligation. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256. The book Income Allocation answers a lot of questions, addresses a lot of the risks that we'll face into and throughout retirement. Tim, you make that one available as well.
Yes. Right. And I also, Peter, we've had a lot of people emailing and calling in with different questions. I was going to go over a couple of those, if that's all right.
Sure. Yeah. Let's hit those. But again, real quick, Tim, if somebody wants the book Income Allocation, they can get that. Just call that number, 800-640-2256, 800-640-2256. The first question, Tim, and again, you can go online, ladies and gentlemen, tjstearns.com, hit the contact page and submit your questions there. The number one question that we have on the list for today, Tim, I have heard that Social Security, the system, will go broke in the next 10 years. Is that true? And what should my wife and I do about it?
Well, it is scary. Some of the things that have been talked about in the halls of Congress and that type of thing, and out in DC. A couple of them are, I don't think it's going to go broke for someone who's a baby boomer, but I do see them making people work longer. Like when my father retired in 1988, the full retirement age was 65. Then they moved it to 66. And then for people my age, which I'm going to be 50, it's 67 now. So I could see that doing that, where they would raise it. The second thing I've also heard about is means testing. So maybe they sit there and say, well, you know what, you're supposed to get, $2,500, but you've been a saver and you have a house and this, that, and the other thing. You're only going to get $2,300. Or look at what they did with Social Security for next year. They raised the cost of living adjustment to about 6%. Right, which is a good thing for us, right? But then they also raised the cost of Medicare for the health insurance about the same amount. So it's a wash for the year if you're on Social Security and Medicare. So that's, something that needs to be talked about. So far they just keep kicking the can down the street. So the quick answer is I would not count on the government for anything at this point, because they're printing money quicker than anything. What did we say? 4 out of $10 on the street right now are from in the last 8 months. Mm-hmm. Right. So that's what I would say.
Yeah. And in fact, you can actually go to Federal Reserve economic data charts about the currency in circulation. It's scary. 20% of all money in circulation created since the onset of COVID in the last 18 months or so. And so that's watering down the value of the dollars that we have. And it's like this next question, there are some additional stresses and strains. Tim, another question that was submitted, and we're hearing more and more of this situation, unfortunately. I am 63 years old, wasn't planning on retiring yet, but my company just let me go. Should I start taking my Social Security now or wait until I reach full retirement age?
The quick answer there is simply I would do a Social Security optimization report for that person and see if they can wait a little bit. If you can't pay your bills, then obviously you're going to have to probably pull it down earlier than your full retirement age. But if you do a written income plan, you know the answer to that already, and you can figure it out by just backtracking it. So one of the things we do is we use a software that will tell people when the crossover is for husband and wife to determine when is optimal.
Well, that Social Security report and analysis by itself, if that was the only time and investment that you put into planning for retirement, that alone can make the swing in several hundreds of thousands of dollars over the course of average life expectancies for a married couple. And it's not an easy solution. It's not just a one size fits all. There are over 81 different potential combinations just on whole year increments for any married couple. And there's a lot of advanced strategies beyond that. I've heard that the number of different potential scenarios is 500 plus different potential combinations for Social Security. Tim Stearns will help you narrow that down and find the optimal scenario for you. And you've got to get that education ahead of time. That's part of the Protect and Grow plan and the retirement income planning strategy session. Pick up the phone, give a call, no cost, no obligation, and again, can make a difference in several hundreds of thousands of dollars potentially. 800-640-2256. That's 800-640-2256. And Tim, they don't actually provide that advice down at the Social Security Administration office.
Correct.
We actually have to proactively go out and get that kind of guidance ahead of time.
Right. It's actually against the law for them to advise you. They can answer questions, yes and no, but they will never tell you, oh, you should take it early or your full retirement age or wait till age 70.
And they don't know the rest of your financial situation, so they don't take on that liability. Right. Another question, Tim, do I need to take an RMD this year? I didn't need to take one last year.
And the quick answer is yes, you have to this year. Unfortunately, a lot of people don't want to have to take the money out because they have to pay taxes on it. But, we got a reprieve last year, but not this year.
Yep. So start that calendar back up. And a lot of people are going to be, first time RMD takers this year because the laws on that changed. So we got to skip a couple years anyway, and all kinds of complexities. But the bottom line, basically, if you were born in 1949 or before, probably need to look at taking that RMD this year in 2021, even if you didn't have to last year.
And one thing, Peter, a lot of people in our classes or they come in the office, they don't know about the Secure Act, and that is a huge thing. And then I don't know if you've heard this, but they're talking about the Secure Act 2.0. And then what they're going to do is instead of us having to take the money out at 72, they would push that back to age 75. All right. And then the other thing they're going to do, these were the two big keys from what I read, and it already made it out of the House Ways and Means. So they're going to be voting on this sooner than later. The other big thing was instead of $6,500, if you're over the age of 50, you could put up to $10,000 into your more than you do in your normal 401k. So those are the two major things. The Secure Act obviously did away with the stretch IRAs, which I think a lot of people are not aware of. Now you're taking money out at an older person's age when you're in hopefully your best working years where you're making a lot of money. So what does that translate to? A lot of taxes.
Well, they have a plan. Death and taxes, as Benjamin Franklin said, the only two things in life that are certain. And I don't know who to attribute this to, but I heard a recent quote that was a play off of that. They said, the difference is that death doesn't get worse every time Congress gets together. So
that's Will Rogers.
Yes. Yeah. Okay. Thank you. Yeah. Now I know who to attribute that one to. Tim, another RMD related question was submitted. And again, ladies and gentlemen, if you've got questions, submit them to Tim Stearns. Get them answered on air or in person. Give a call, 800-640-2256, or go online, tjstearns.com, tjstearns.com. Hit that contact us page. Another question, Tim. I need to take my annual RMD this year, but I don't need the money. Can I give it away to a charity and not pay tax?
Yes, you can. And that's one of the things we're very happy about at our office, that we have a CPA on staff. And Joe is our CPA that I've known for over 35 years of my life. He's excellent. Again, he's well-versed in how to, obviously most people, when they deal with taxes, they're reactionary, and we try to be proactive. So yes, you can do what that person was asking, give it away to a charity so that you don't pay taxes on it, but you need to be careful about how you do it.
Well, if you would like to get specific guidance for your situation, if you'd like to review and evaluate the amount of risk that you are taking in your portfolio, if you'd like to talk about how to protect your assets from the possibility of a potential market downturn into our future, if you'd like to maximize that Social Security, review your options there to optimize that decision, if you'd like the book Income Allocation, if you'd like to attend a retirement workshop and educational class, any of those are available, and those are the opportunities that Tim Stearns makes available for listeners to this program. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, another question here, and maybe time for one or two more, but how, in general, will the proposed tax law changes impact my investments? I know they acknowledge this is a general question, but we are hearing a lot about potential for tax law changes. What do you see happening there as far as what that means for our investment portfolio?
Well, I see taxes going up. They've never been lower really in forever. So I see taxes going up. One of the parties has all the White House, the House of Representatives, and the Senate. Kind of what they want to do is what they're going to be able to do. So I see taxes going up, which again would be a nice time to do a Roth conversion. If you're, and bring you up to the next tax bracket, just you nibble on the bill, if you will. I see that happening. They've also talked about moving capital gains, from 15 or 20% to 20 to 25%, depending on your income. So I see all those things. And why do I see that? Because someone's going to pay for this infrastructure bill, and someone's going to pay for all the handouts that they gave to the American public. And I get why they did that, but as they say, those roosters are going to come home to roost. And at some point, we as the people that pay our taxes are going to be paying for that bill.
Just another concern that we have that may drive the direction of the market into the future. What is going to happen with taxes and tax law changes? And it's why now more than ever, you need to be proactive, ladies and gentlemen, in controlling both the amount of risk that you're taking that is dependent on the direction of the market and your tax future. How do you control that bill and minimize that where possible? Those are things that Tim Stearns and his team there at TJ Stearns Inc. talk about with their clients each and every day. If you're already a client, you understand the benefit. If you're not yet, give a call and find out. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, we always appreciate the insight that you provide, the direction here on the show, and the knowledge and information that you bring to Chicagoland area savers and investors.
Peter, thanks for having me.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.